Hey everyone, my name's Andy from the Finding Value Finance channel. Today we've got Justin Huhn from Uranium Insider with us. Wanted to get him on. I know the sentiment around uranium right now seems pretty low to me, at least. A lot of people are asking me questions. Is it a good time to buy? Are we going to crash? Are we going to do a flush out? First, I'll say, I don't know what the immediate future is going to be. If I did, I'd probably play it completely right. But Justin, I don't follow the news as much in uranium. I mean, I do and I don't. What's kind of going around right now? What are you seeing? What's in the news? What are some important things that you're seeing that maybe people should know if they're uranium holders?
Well, the news has been relatively quiet as far as, I would say, short-term affecting catalysts. So the type of news flow that might affect the stocks in the short term has been relatively quiet. But there's been a couple of big pieces of news over the past few months, at least since we've spoken, that are definitely pointing to something very positive for the long term. But obviously, the market doesn't really care in the short term. So those things are, for example, Kazatomprom reporting on their 2022 results and recognizing an almost doubling of their profit margins, while their capex has also increased substantially. So they're having to put in a lot more money simply to maintain operations, and they actually flagged that their production for 2023 would likely come in underneath their targets, and actually even called in 2024 into question. So that really is only important because to understand, in mining, you have, especially for existing producers, you have a nonstop depletion of existing assets. And so especially with an ISR mine, you have to drill new wells on an ongoing basis constantly, simply to maintain production levels. And so the primary bear thesis, which is Kazatomprom can just turn on the taps, that's essentially utterly wrong. Can they increase production? Of course they can. They need to secure a better ongoing source of sulfuric acid, which is their lixiviant in their ISR process, which they're doing. And they need to invest far, far more capex into expanding their well fields into new deposits and expansion within existing deposits. And of course, just like any mining asset, you high grade it, right? You go for the nose and you hit that first. And from there on out, typically grades decline within a deposit. And so it takes more and more capex to maintain production within any given deposit. And even Kazatomprom will show you future expected production, and considering they will be able to increase slightly, they expect their production peaks in the early 2030s and declines extremely fast from there on based on their known resources as of now. So that piece of news is important because it's like, oh, Kazatomprom's just going to turn on the taps. Well, no, not exactly. Will they likely try to increase production a little bit? Probably. Is it going to be a market-killing massive expansion in production like we saw during the early stages of the bear market, 2011, 2012, 2013? No, absolutely not. So that's kind of important to understand. We also had, let's see, the United States Department of Energy released something called a liftoff report. They did so for renewable energy, for hydrogen, and for nuclear. And this report was relatively expansive and essentially was suggesting that the United States triple nuclear capacity by 2050. So this is all being pushed, of course, by their net zero goals and trying to get to carbon neutrality by 2050. And so this is pretty phenomenal, because if you go back 3 years plus, I think if you would have asked myself, if you would have asked, Mike Alkin and Tim Chilleri from Sachem, or Ardent Adam from Segra, or any of the other kind of big players within the space who really, really understand the market and are modeling out supply and demand in the future, if you would have asked any of us at that time, is it possible we'll be modeling for new nuclear capacity in the United States? Everybody would have said, they would have laughed at that question. So of course, we're still a ways away from new capacity actually being added. But the fact that the Department of Energy is promoting a massive expansion of nuclear capacity in what is already the largest nuclear producer in the world is pretty significant. So does that mean that that's near-term demand for uranium? No, of course not, it doesn't. But what it does mean is a significant signaling kind of to the world For better or for worse, there's still a lot of countries, especially in the West, that kind of look to the United States of where they're going with, policy wise, and the fact that we saw the IRA and we see the UK doing something similar. It's a big shift in terms of the embracing of nuclear rather than the shunning of nuclear. So we'd like to see further follow through on that. I think the IRA was a big step in that they actually secured funding for supporting nuclear. Now you have about half of the utilities, the nuclear utilities in the United States, looking at new nuclear, looking at actually getting licenses for expanding nuclear in the United States. So that's pretty big. And so this liftoff report is pretty incredible. They also there was a section in the liftoff report where they did kind of a forensic analysis of the Vogtle plant in Georgia, which basically just recently connected to the grid. This plant famously went many years over time on their build out, many billions of dollars over budget. So it's kind of like the poster child of why nuclear is too slow and too expensive. And this liftoff report kind of went into that. And what are the reasons? Why did it take so long? Why did it cost so much? How can we avoid this in the future? So that was interesting. And one last thing I'll mention about the liftoff report was that there was an analysis as well of timeframes for reaching the goals of nuclear expansion based on when the expansion starts. So what they're basically saying is, if we wait until 2035 instead of 2030 to actually start building these new reactors, that means that the expansion on an annual basis to reach our goal for 2050 is, like 50% more. So just literally waiting five years to actually get this going, 5 more years. That means, the annual gigawatt expansion, instead of being 13 gigawatts, is 20 gigawatts a year, right? So these are incredible numbers. Will we reach that? Even if we get half of that or a quarter of that, that's still not on anyone's bingo card. Nobody is modeling for new uranium demand in the United States. Zero people are doing this. So that's kind of this wild card, and I think that's pretty significant. Gosh, what else have we seen in the past few months in terms of news?
Yeah, go
ahead.
Did Germany did they shut down their nuclear plants?
They did.
Why? Why would you do this?
I think the easy answer to that is just ideology. It really is. It's the German Green Party essentially committing to doing what they said they would do about a decade ago and just following through on that. So even though actually now the majority of the populace in Germany is in favor of those nuclear plants remaining online, even expanding and restarting some of the plants that have been shut down, which to my understanding, the 3 reactors that were shut down last year, or I guess that was the end of the previous year, 2 of those 3 reactors could technically still physically be restarted without really doing anything besides, getting a new core load going. So yeah, against all logic, they did that. And, I tweeted about it when it happened, which was, I think, 2 weeks ago. The only silver lining in this situation is that it's really happening on the world stage. And they've been absolutely lambasted for this decision. And everybody understands, except for the completely ideologically wrapped who believe this is still a good thing. Everyone understands this means more pollution, more death, more expansion of coal. I mean, there's no making up for this with renewables. It just can't. So yeah, it's definitely a bummer, but it's not something that was a surprise to anybody. And nobody was modeling into their supply and demand modeling that maybe Germany stays on. No, everybody believed that this was still going to happen, even though there were some very intelligent, vocally strong nuclear advocates that were pushing Germany to keep these online that ultimately failed.
This could be positive though, right? Because if something happens where they can't sustain something, they have to turn it back on, everyone's going to see that and say, well, you can't sustain the renewable amount, or maybe they go back on it because of how much coal that they either do have or don't have. And then if they turn it back on, everyone's going to say, oh, wow, you can't run without nuclear. And then I don't know. I'm just trying to look at it from a different perspective than everyone else. Cause I mean, I don't think California shut down. They're not going to shut down Diablo Canyon from what I remember. They were going to originally, and I think they went back on that, didn't they?
It was supposed to
So-
shut down next year, and they gave it a 5-year extension to 2029 and 2030, respectively, for the 2 reactors. There is an environmentalist NGO that's suing PG&E, basically saying that it's illegal for them to break that commitment, to put it in simple terms. But it's got the governor's backing at this point. The Democratic, pretty far left leaning Gavin Newsom, who's apparently going to make a presidential bid. Gag me. This guy is the worst of the worst. But to give him credit, he kind of caved to pressure with keeping Diablo in line, and probably did some back of the napkin math on what that means for his constituency and what they would be paying, the rate paying customers would be paying if that were shut down and replaced with California's expanding solar. So it's likely to remain online until 2029, 2030 at least. Whether it gets extended at that point, I don't know. We'll have to see where the grid is sitting, when we approach that time frame. But yeah, that obviously was a positive move. As far as Germany goes, I don't expect them to turn it back on, because it was already ultra obvious going into the shutdown what was going to happen. So it's not like they're going to shut it down and be like, and be surprised that all of a sudden rates are 50% higher and they have to expand coal. They know, they're not stupid. I really don't think this is a move out of stupidity. I really think it's ideology that borders on religion. And it's a caving to that ideological demographic more than anything. It doesn't make any sense whatsoever from a logical perspective. And you even had, left-leaning kind of green environmentalists that were pushing them to keep it online. So it doesn't make any sense. I don't expect them. They're seemingly willing to deal with self-inflicted wounds more than they are doing the right thing. So I'm not holding my breath there. Of course, it would be quite the signal if they did restart it. But I think it would be equally as much of a signal when the world sees, the carbon pollution skyrocket, and when they see rates continue to rise in Germany. And it's a beautiful case, test case for nuclear advocates to see. This is what happens. This is what happens when you spend, they already spent $500 billion on renewables. They're going to be spending more. So they're going to hit $1 trillion invested into solar and wind. And we're going to see what happens. Okay. Shut down your nuclear and pour $1 trillion into renewables, solar that has maybe a 10 or 11% capacity factor in Germany. It's so utterly stupid, but at least we have a test case. So that's kind of cool.
It's the test bed, and we can see what happens, and everyone else will go, hopefully, the way of cheap energy.
Yeah.
Cheap, reliable, clean energy.
Yeah.
What about the physical front? I don't know, like when I follow commodities, I always look at inventories. I always look at that stuff. What are you seeing in terms of, if you even know, inventories and the physical uranium side? What does that look like that you know of?
So the physical space is where we focus most of our attention on, especially during times like this, where it seems like every day is Groundhog Day with the equities. They're certainly watching a different movie here. It's important to focus on the background fundamentals and recognize just where we believe this is going, and a constant, not really a questioning of the thesis, really, but a shoring up of the thesis, making sure we understand the physical market. Because if you can't make a bet on where the physical market is going, then the uranium price action, the equities price action, sort of becomes the narrative, which we believe right now is full on wrong. And again, back at a contrarian investment opportunity. So we've gone from a contrarian investment where everybody hates uranium and nuclear, and the price is never going to move and the equities are never going to do anything, to a flush in March 2020, a few months of recovery, and then boom, an absolute liftoff. Then we had all the momentum. We had institutional retail money pouring in, chasing the price on the screen, right? That lasted for a few months, pulled back for a few months, and then another leg up. And that's what we saw for about a 12-month period, December 2020 until November 2021, was a big giant leg up where equities returned multiples. Now we've had this long pullback, close to 18 months of this kind of declining. So it's not really a falling wedge. It's kind of a declining, not really declining channel, but sort of a correction with a few intercorrectional rallies that we've had over the past 18 months or so, but a big reset in terms of valuations. While at the same time, The commodity is firm and rising. We had a spike because of Sprott buying, but if you kind of negate that spike, the commodity is firming up in this absolutely gorgeous ascending triangle. And that will break to the upside. I don't care who's doing TA on this. This is a physical commodity that is driven by supply and demand. There's essentially no futures market. There's no paper trading, manipulating the market, nothing like that. It's literally buying and selling based on actual demand, primarily coming from nuclear utilities that have to operate these gigantic paperweights if they don't have fuel. So the commodity is firm and it absolutely is going up. This is, I tweeted this as well. This is the easiest trade I've ever made in my life when it comes to betting on the commodity rising. Now, the uranium mining equities, they have been beaten down pretty bad. Could they go lower? Absolutely. That's entirely possible. Especially scary if you look at the S&P, which has got a lot of space below it if it were to correct, and perhaps we would go down with it to sort of a final flush. That's entirely possible. I don't know whether that happens or not. What do I know with 100% conviction? The commodity is firm and going to rise. So we, we do these monthly webinars with our membership, and we had Bram van der Elst on our webinar last week. Excuse me. So Bram is a trader. He's a uranium trader with Curzon Uranium. And he's very, very intelligent, very sharp. He really understands the physical commodity market more than probably anyone I've spoken to ever in this market, with maybe a couple of exceptions, which would be other traders, right? So these guys, this is their living. They buy and sell uranium. They know what's going on in the physical market. Bram is also going to be the uranium trader for the new physical fund that's being launched, which is the Zuri Invest Actively Managed Uranium Certificate, or AMC is what kind of the market's calling it. This is not going to be publicly traded, but you can buy and sell it through a brokerage, through an ISIN, and they're in their initial financing raise right now. They're doing their initial raise. That was supposed to close last week. They decided to extend it by a month. Supposedly they've been having, a couple of banking issues in terms of investments settling with the fund in a timely manner. So it sounds to me like they're seeing pretty strong interest in the fund, and they're extending that 1 month. So that should close in about 3.5 weeks. They're shooting for $100 million. I'll get back to the physical market, but I wanted to set this up because it sort of ties into that. So this fund is structured differently than SPUT. So SPUT, because it's publicly traded, it can trade at a discount or a premium to NAV on a daily basis. And as the fund matures, especially in sort of a risk-off market, especially as far as the uranium equities are concerned here, it's traded at a big discount to NAV. So even right now, it's sitting at like a 14% discount to NAV. That's pretty big. And it's been sticky. So we've been between a 5% and 15% discount to NAV almost exclusively for the past 6 or 8 months, with a couple of short exceptions. And they can only actually go in and buy uranium when they're able to raise cash, and they can only raise cash when they're at a premium to NAV. So they require somewhat of a risk-on environment and capital flows to get them to that premium to NAV in order to be able to raise money on their ATM, which is at the market financing vehicle that they can sell shares into the open market, raise cash, buy uranium. That's how they operate, okay? And that's perfectly fine. When that risk comes on, and then they can really come in hard. So for example, they raised close to $100 million in a couple of individual days, in a single day. That's a lot of money to raise in a single day to buy physical uranium. And we saw the price reaction to that, right? That was September, October, November 2021, April 2022. And then there's been a couple of fits and starts since then. So that discount to NAV also technically offers somewhat of an arbitrage opportunity for somebody who wants to buy uranium at a discount, right? If you want exposure to the commodity, why would you buy it at NAV if you can buy it and get a 15% discount? Even it's SPUT trading from a 15% discount to a 5% discount, assuming a flat spot market, you've made money without the uranium price moving. So you have kind of that added factor of the Sprott vehicle. But at the same time, if you want to exit your position in the Sprott vehicle, you might be forced to do so at a discount to NAV as well. So anybody who has wanted to increase their cash position, let's say over the past 2 months, and reduce out of SPUT, you've had to do it at a discount and just eat that. So if you bought at NAV and selling at a discount, then you're losing some of the torque that you could have gotten from the commodity itself, right? So this vehicle will be at NAV all the time. Because it won't trade publicly, it will never alter or falter, I should say, from trading at NAV. So if you buy a position in this vehicle and they raise enough cash to buy a minimum lot of uranium, which is 100,000 pounds, they buy uranium. So your money going into this new fund, all of it, except for I think it's 1% fee, goes to buying uranium, period. If you put $100,000 into the spot vehicle right now, none of that goes to buy uranium. So you're still taking a position that is exposed to the commodity, but your money isn't buying physical uranium by taking a position unless they're at a premium to NAV. Whereas in this vehicle, every dollar you put into that, 99 cents goes to buying physical uranium. That's significant, okay? Another element of this is that they have a redemption vehicle. So if you go in and redeem part of your exposure in this vehicle or all of your position, they will actually redeem that position in physical uranium if they can't mark off that sale order with a buy order. So if they can do that, they'll do it. Second, if they have sufficient cash to liquidate your position, they'll use cash. And the only reason they'll have any cash is if they have less cash than is necessary to buy that minimum lot. So right now that would be, 5.1 million or whatever. So if they've got $4 million in cash, they can't buy that minimum lot of uranium. So they're sitting on that cash. So if you liquidate your position, boom, cash. If they got insufficient cash in the fund to liquidate your position, then they'll actually go in and sell some uranium to raise that cash. They don't trade uranium. It's a buy and hold, but they will sell uranium to redeem positions. Okay, so that's important to understand. And lastly, possibly most importantly, they will be buying in the front month only. So technically for a spot market purchase, settlement can go out as far as 12 months. And this entity is committing to buying in the front month. So within 30 days settlement only, which is, in this market, that's basically considered immediate settlement. What that means is to the extent that capital might flow into this vehicle, that will create instant price discovery, because most players that are buying and or selling in the spot market are not demanding immediate settlement, right? If you're a utility and you need to nibble on a few 100,000 pounds, you're not like, hey, I need this now, because it's uranium. You've got to convert it. You got to get it enriched, fabricated fuel. So there's very, very rarely is a utility urgently seeking settlement of physical U3O8. Okay, I would argue probably never, but very, very rarely. Maybe there's some circumstances where utility is short or something like that, but extremely rarely. Same thing with traders. Traders are usually structuring deals that, like a carry trade, for example, a utility will sign a contract with the trader and they'll commit to delivering uranium a few years out on the curve. And then they'll kind of nibble on the spot market, and they don't need that settled right now. They're going for the lowest price they can get in the spot market, which usually is not the front month. If I want to buy 2 million pounds of uranium now, I'm going to have to pay up for it versus saying, hey, I'll take that in 6 months. So no worries. Right. So Sprott's had to go out on the curve a few times, a little bit, maybe 3 months plus, because of the volumes that they were buying. But this vehicle, front month only. So let's say, for example, they raise $100 million in this raise, and they go in to buy almost 2 million pounds, 1.9 or whatever that can buy, based on 50, let's see, about $51, a little bit 51 something here in the spot market. If it's not there at the existing price, they don't go out on the curve. They raise their bid, and they keep raising their bid until it gets filled. And that's how this fund is going to operate. And it'll always be at NAV. So we'll see. The effect it's going to have will be dictated by the capital market and the capital flows going into this vehicle. Very, very curious to see how much they raise in this first round. And then from there on, it'll just be through brokerages. But the way that it's structured, I think it could have a significant impact. And I think we could see, depending on how much they raise, if they raise north of 100 million, If it gets oversubscribed, we'll probably see a little bump in the spot price. And of course, if the capital flows stay consistent, even if it's not going in for a $2 million chunk, if they're buying 100,000 here, 200,000 there on an ongoing basis front month, that is going to put a solid floor and an accretive pressure on the spot price, 1,000%. There's just very little, very, very little mobile liquid inventory right now in the spot market.
How do you know it's very little? How do you know? Is it because the lack of selling pressure in the commodity itself? Is that what you're using to gauge that?
Exactly. Yeah. I mean, if you watch volumes and you watch the way that the price is moving or not, that kind of tells you. And then of course, just our contacts within the industry talking to uranium traders will tell us, if you want to go in for this many pounds, it doesn't exist. You have to go out on the curve. Because there's always some production coming in the spot market, right? Mm-hmm. So there's only so much. It's maybe a couple million pounds a month. But if you go out on the curve, that liquidity is there. And maybe there's a little more liquidity in the short term now because financial has been out of there. But we're seeing a rising spot price right now with absolute zero financial interest. So the market is firming up. And we've seen spot, what they purchased, maybe 2 million pounds this year, which was over a couple of weeks, late January, early February. But they've been out of the market entirely for almost 2 months, and the spot price is absolutely firm and rising. So that's a tell. That's a tell. It's just basic supply and demand fundamentals and dynamics of commodities pricing. Like, commodities don't fall in an undersupplied market; they rise in an undersupplied market, and so that's prima facie evidence right there. If you just watch the spot price action, that's exactly what's happening.
Yeah, and what's interesting is we're seeing the equities fall. We're seeing the spot price either go sideways or slightly higher. Your equity to commodity ratio continually gets better and better as time has gone on in the short term here, because we've had the equities fall down and we've had uranium go up. So that's generally right when I get really interested and really excited.
You're absolutely right. Yep. So this chart is URA compared to the spot price of uranium. Now, I'm using URA here because it'll give us a little bit more of a historical perspective, because URNM launched in late 2020. So here you can see the equities valuation. Now, URA, again, it's only 70% allocated to pure play uranium mining stocks, but we've almost had a complete round trip in terms of valuations of the miners within URA compared to the spot price of uranium. We're almost back down. In fact, we are literally at levels prior to the launch of the bull market, in my opinion, which was December of 2020. Now, you could argue that the absolute bottom was March 2020, which it was, and we recovered for a few months there, pulled back into the summer. And then leading up to December, we absolutely took off. Now, of course, this is a move compared to the commodity, and the commodity was relatively firm at that move. We didn't see a big commodity move in December of 2020. It was firm and overall rising, but it wasn't a blast off in the commodity. In fact, that's probably why we saw that pullback going into the summertime. Or excuse me, we saw that pullback going into the summer of 2021, which was right before SPUT took over. So when SPUT's ATM launched, that was August of 2021. And we saw another move up in the equities for a few months relative to the commodity, while at the same time, the commodity was soaring, right? That's when the commodity really took off. So if we actually chart the commodity itself, which, by the way, I don't really like to make predictions on price movements based on technical analysis of the commodity, at least not with this commodity, because nobody is trading this commodity based off of this chart. Zero people are. Maybe people are trading SPUT or an equity related to the spot price based on charting the commodity itself. But like I said, with an exception of some spikes that were like this spike right here that came up and pulled back down, that was April of last year, with SPUT coming in buying in the market. So that was sort of this, I don't want to say it's like synthetic demand, but it sort of is synthetic demand. This is not demand that's being dictated by the actual physical market, but it is a consuming of material, and it does have an effect on the overall physical commodity market for uranium. So while the bet is not on financials consuming more uranium, that is happening, and it is going to continue to happen. But the commodity itself, if you were to chart this, I mean, we had this breakout, kind of this false breakout, and came back down with the SPUT buying. But to me, this is the most ultimate classic oops, I didn't draw that very well. Ultimate classic ascending triangle. Just absolutely, absolutely gorgeous in my opinion. It's always been my favorite chart pattern to trade from a momentum perspective. And a breakout of an ascending triangle on volume is like the best long signal for me. Because for me, my technical analysis is really, really, really basic. I keep it extremely simple. And what makes sense to me logically, as far as chart patterns, that's what I tend to believe in. So the logical perspective is when over the past year and a half, the commodity has hit this 51, 52 level and is sold off repeatedly. And every time it's sold off to a higher low. So the buyers have stepped in at a higher price every single time we've hit this resistance, with an exception to this breakout. And to me, that makes perfect sense. That to me, that's accumulation. So I think this is an absolutely gorgeous technical setup for the commodity itself. But if we go back to, let's say, just charting URNM, for example, we're on the weekly chart here. We're making a higher low from last summer, which was a higher low from the summer before. So we've got a bit of a trend line here if you are to chart kind of the bottom here. But of course, we got plenty of room for RSI on the weekly to fall. The momentum is certainly to the downside here, although it does seem to be making an attempt at bottoming over the past month and a half. Perhaps that will be the case going forward. I really don't know. But clearly, it's not a bullish looking chart as far as momentum goes. If you want to chart it, I know that our mutual friend Scott really loves to chart this 200 weekly EMA. And a lot of the stocks in the space are chopping right around that 200-week EMA. So perhaps we get a flush down somewhere here and kind of a false breakdown. That's entirely possible. But I think we're getting close to this sort of triangular pattern coming to an inflection point here, right? I mean, this really is kind of getting down to the nitty-gritty here. So a move, in my opinion, is coming. Which direction it goes, I have no idea. But if paying attention to the physical commodity market is any signal, that is going higher. I can say that with great confidence. The last thing I would probably mention here is that the large caps like Cameco, look at that chart. That's absolutely gorgeous. This chart, this is holding up very, very well here, especially on a relative basis. Cameco is holding up well. Kazatomprom also looking decent. That's a pretty nice looking chart in my opinion. So Cameco, Kazatomprom, and to some extent SPUT as well, holding up better than most of the equities in the space. My theory on that is a small number of institutional, let's call it smart money, is accumulating the stocks that they can actually touch. So for these smaller plays that are far less liquid, those are a little bit too risky in this environment. If you're taking a contrarian position as a institutional player with a decent amount of assets under management, you have to go with what's liquid. So what do we have that's liquid? We've got SPUT, we got Cameco, we got Kazatomprom. That's pretty much it. To some extent, the ETFs, but something is happening really interesting with the ETFs, which is over the past the past 4 or 5 months, we've seen pretty consistent redemptions coming from URA. So a decreasing in share count, basically money moving out of URA, and share count increasing on URNM. So there's been funds flowing out of URA and flowing into URNM. And the volumes have been low enough that that doesn't drastically affect the difference in these two charts. URNM tends to underperform URA when risk is off and outperform when risk is on, due to its 100% allocation to miners versus 70% to your pure play uranium miners for URA. But money is moving out of URA and into URNM. In fact, if you take URA at a 70% of its AUM based on its exposure to miners and compare that to the AUM of URNM, URNM is about to surpass URA and AUM with account to their pure play exposure. So money is moving into the pure play. I think that's somewhat of a tell as well. So I think we're seeing some very slow, lower volume, smart money positioning, and that's why we're seeing Cameco, Kazatomprom, and Sprott hold up better than the rest of the equities in the space. And of course, the URA redemptions, that's selling by the ETF. So we've seen that, and that's been in a greater volume than the share issuance by URNM. So that's of course affected the market as well, the selling by the ETFs. I know you asked me about the physical market, so I don't know if you want me to get into the weeds there, but
What about URNJ? Isn't that something new that came out? What's your opinions around that? The
I like
ETF
it. I
URNJ.
like it. I've been buying it for my daughter's investment account. She makes very small monthly contributions from her job at the local bakery, and I add a little bit of money there as well. And every once in a while, I mean, I love this account. I actually love this account because I treat it differently than my own account. I tend to get a little bit more active and impatient with my own account. So I tend to kind of buy and sell a little bit more and play around with things a little bit more in my own account. But her account, I look at it maybe once a month, maybe once every 2 months. And I go in there every month or two, and there's a couple $100 sitting in there. And I just add this to another position. And so I've been nibbling away at URNJ and down like 15% on that one, but I just keep buying it. I like it. I like that it's pure play exposure to juniors. And it's really not all that different from URNM. It just cuts out, I think, 2 or 3 of the larger cap stocks. It might also actually have a lower threshold for inclusion. So I think it carries a few more juniors as well. That thing is going to fly. When risk comes on, that's going to absolutely fly. So I feel great about nibbling that while risk is off here. And this is like, oh my God, it's just such a gift. Well, understanding where this market's going to go and feeling so confident for the years to come. Just this pullback here has just been an absolute blessing for anybody that continues to accumulate.
Yeah, and this question isn't aimed at any specific company or anything like that, but what's your take on creating a portfolio of, we'll call it speculative companies, junior companies, whatever, in relationship to URNJ? So, I mean, do you think URNJ would still perform quite well, or do you think someone could construct their own speculative portfolio and still beat the returns of URNJ? What's your opinions there?
Yeah, I'm sure you can construct your own speculative portfolio and beat URNJ, because they're going to have a pretty unbiased allocation. So they're just literally going for liquidity and market cap. If it's a uranium mining stock that has sufficient market cap and liquidity, they're going to buy it. So they're not looking at the quality of the management or the share structure necessarily, how many warrants and options are outstanding, where the jurisdiction is located for their primary deposits, things like that. So you can get a little bit more pointed, and they're going to own kind of a basket of pretty much everything that will fall under their categorization to it for inclusion. So certainly, yeah, it's probably going to be more stable, I would say, than a smaller basket of speculative stocks. But I do think if you're going to speculate on very small cap exploration stocks, that it's good to hold a big basket that has very small individual positioning, unless you're very, very sharp and do very deep due diligence and you understand very thoroughly the share structure, the history of management, and the likelihood that their project will either hit strong drill intercepts with exploration or actually be able to move towards development. By the way, you know that there's 118 uranium stocks now?
No, I didn't know
118.
that.
We've gone from 60, 65 about 2.5 years ago to 118. Quietly, this sector is absolutely expanding. I also think that has something to do, not a huge effect, but has something to do with the general performance of the uranium equities, because the minimal capital that is in this space now is being spread a little bit more thinly. Even though 50 of these 118 are probably less than a $5 or $10 million market cap, they're tiny stocks, but you don't see that. You don't see company expansion like that when we're about to head into a bear market. Like the guys running these companies, then there's a lot of offshoots. So a lot of companies have been selling off non-core assets, either to companies that they themselves are also creating on the side, or newcomers in the space are speculating on uranium, and they're coming and they're buying up non-core assets from companies that are looking to create cash without dilution, especially in this capital market. So the number of companies that has really, really expanded. I think that's another tell.
And I got another question, and I don't know if people ask it a lot, but and we don't need to get into specific companies or anything like that, but in your opinion, what's the risk difference between a junior company and, say, something like a Camco or a Kazatomprom, or some of these larger companies? Like, how would you quantify that difference in risk when somebody goes and buys it? Because I know a lot of retail investors, they come into the space and they just go full swing, swinging for the fence, and then they continually get diluted in some of these small junior companies that have to raise a lot of money for exploration or whatever. Um, how do you, what's your thoughts around it? How do you think about it in terms of the risk and maybe even risk reward, however you look at it, perspective?
I mean, to put it really simply, the smaller cap the stock in the space, you're going to have probably pretty drastic underperformance when risk is off and outperformance when risk is on, because you're going to see, generally speaking, a rising tide will lift all boats. But there is kind of this section of uranium equities, let's say, that is small enough market cap that they aren't included into the ETFs. So when risk does come on in the sector and the ETFs are buying, they don't get included as part of that buying, right? So that's obviously so small that you're really kind of betting on some kind of catalyst for the company to draw attention that'll bring in flows that are not coming from the ETFs. But you also have this situation where, mining exploration is expensive. So for a company to fund a small drill program, they still need to raise, $2-3 million plus for a very, very small drill program. And if you've got a $10 million market cap, that really hurts to raise that cash. That really, really hurts. Plus, the company is so small and so speculative that they've got to juice up the offer. So they give a 10-15% discount to the current stock price and they throw in a full warrant. And that really, really screws existing shareholders. So if you're betting on a really tiny cap explorer, you better feel damn good about their prospects going forward. It also makes sense to look at their cash position at the time that you invest, so you can gauge how soon they're going to have to raise. And I think it's just much more risky. Now, when risk is on, if you have a small cap stock hit a decent discovery during risk on bull market situation, you can have vastly greater returns than just owning Cameco or URA or whatever it might be. So no guts, no glory, I guess. But if you want to sleep at night and you want liquidity, the small cap exploration stocks are not where you should be putting your capital. To put it pretty simply. And obviously we can see the charts I just shared with you, that over the past 6-8 months, when the equities have generally been performing pretty poorly, the large caps have held up way better. So it's a much safer place for your capital, but you're going to underperform when risk comes back on, and eventually it's going to come back on.
So right now, would you consider this risk off, really low sentiment? It's basically not in favor.
I've been through a lot of these cycles. I mean, even within just the uranium space since 2016, this has happened many times where we've seen big pullbacks. In fact, the drawdown from some entries in like 2017, 2018 to the March 2020 lows is greater than the drawdown we've just experienced. So this is not something that's new to me. Maybe that's why I tend to have a little bit more of a calm demeanor about it all. But I would argue that sentiment is the worst I've ever seen it, ever. And that's juxtaposed with the most positive fundamental setup that I have seen. Like I said, this is the easiest bet I've ever made, ever. So there's no questioning where the commodity is going. The capital markets have a different story, and the equities markets are watching a different story right now. So just is what it is. It happens. This is a bloody resource markets. I shared a tweet over the weekend where I showed a historical chart for Denison. Now, Denison Mines, back in the previous bull market, made a really good strong run with multiple pullbacks. So I apologize, I'm forgetting the stock prices off the top of my head, but actually I could probably look at the chart while I'm telling you this. It made a good run during the first leg up, right? So it went from, let's see, from the first leg up, it went from about 12, 15, 20 cents on that first leg. And that was at the very bottom. And then it launched. And the first real big run, it went to about $3. So it went from, let's see, July of 03, it went from 40, let's say 45 cents to $3 to March of 04. So in about 8 or 9 months, it had a huge run. Then it corrected by 54%, got chopped in half. Okay. Then another run up, then a 35% discount, another run up, 40% pullback, another run up. And then this last run here, actually, let me show you, I'll share my screen again here.
Go for it.
So this is what I had shared on Twitter, because I think what I was trying to say is, like, I'm not trying to draw a correlation to what's happening now. I was just basically trying to make an obvious example that, historically speaking, there's plenty of examples of an equity moving against the fundamental sector that it follows. So during this period of time right here that I have highlighted, this was September of 05 to, I think, October of 06. So basically a year, a little more than a year. From the high point to the low point, Denison corrected by almost 50%. Okay. During this 12-month period, this is going to blow your mind. During this 12-month period, the S&P was up 15%. The uranium price was up 60%. So you're sitting here holding on to this stock, right? And just, put yourself into this position. Maybe not yourself, because I know how you think with these things. It's similar to me. You're in this for the long haul. So this is just kind of something to sit through or add to. If your conviction is high, I'm with you. But for most people, maybe they're sitting on gains. Maybe they entered in 2020. Or even, at certain low points in 2021, they're still sitting on gains right now, but they're watching them evaporate day over day while the spot price is up and the S&P is melting up, right? So this situation, you're like sitting on massive gains here. Denison, almost $8. And if you had bought at any point along this lines, even if you bought the previous high point, you're still sitting up. Now, if you had bought this previous high point and you're down on your investment, let's see, the high point from there to the low point here, you're down 35%. There's a hell of a lot of people in uranium right now that are down 35% and are really worried about where this is going. Okay. So you chop sideways to down for a year while the uranium price is climbing, climbing, and climbing, and climbing, and climbing, and climbing. And the idiots that just went in and bought the blue chip, the blue chip S&P, and they're sitting on their hands, they're up 15% in the thing that has the most liquidity. Here you are speculating on the next big thing, and you're down, and the spot price is up, and the S&P is up. It's like, this must have been absolutely maddening. I guarantee you a lot of people got shaken out during this period. What happened at the end of this period? Denison tripled in the next 4 to 5 months. And so I'm not saying we're about to see Denison triple. I'm not saying that this has strong correlation to what's going on now. What I am saying is there's plenty of historical precedent for equities to move against the commodity and against the overall broad market, even within an overall longer-term bull market that ran for another year after this correction. And I think the run after this correction is going to last a hell of a lot longer than a year. But I just think that's really, really eye-opening to me. And then I also compare that to, like, the classic Rick Rule story, which is it's even cliche to talk about at this point, but I think about it all the time, because I can't imagine sitting on a 90% decline in an equity that I bought and having the conviction to buy more rather than just capitulating and moving on to the next thing. And that's what he did. And even if he hadn't added following that 90% decline, because it went from 10 cents to a penny, well, it ended up going to almost $10. So you still had 100x, even if you didn't average down on that, right? But he did average down. And that was probably in one of his best investments of his entire career. And how many people have the conviction to hold in that type of drawdown? I would argue almost nobody has that level of conviction. But some people do. And historically speaking, on the subject of Rick Rule, he did a really interesting interview recently with my friend Ben Mummy, who runs a channel called something, shoot, I'm forgetting what it's called. Something about Path to Greatness or something like that. It's a really interesting channel. It's kind of focused on investing, but also sort of motivational. But he's talking to Rick Rule about mental models. And during part of this discussion, Rick said that he did a pretty in-depth analysis of all of the 10 baggers he's had in his career. And he didn't mention them by name, but he said, without exception, all of them took at least 4 years, and most of them took 5 or more years. And all of them, with no exceptions, had at least one 50% drawdown during that 10-bagger experience. Every single one. It's like, yep, these resource stocks, they're rough, they're volatile. But you cannot have those outsized gains opportunities without having volatility to the downside as well. So that's where we're at. We're in that part of the cycle. It's not a lot of fun, but if you have a long-term outlook and you have conviction, then it can be an incredible opportunity for contrarians.
And one last question here.
Yeah.
Are we early, middle, or late to this bull market?
Early. We're early.
How early? How early?
The contracting cycle hasn't even started yet. Hasn't even started yet. We're very early. We're very early. We're going to see a 5+ year contracting cycle of replacement rate or more. That's my opinion. We're going to see $100 uranium with zero interest from the financials. And if the financials come after it, it's lights out, and it's going to go to levels that I don't think anybody can predict based on charts, based on historical analog, adjusted for inflation. None of that is going to predict where it can go. It's going to be up to the capital markets. And, you know, this is affected by the capital markets, which is why we've seen the depth of the correction we have. In my opinion, it's been exacerbated by that. But the commodity itself is going to keep rising, with or without SPUT, with or without Missouri Invest AMC. That's where it's headed. So we're very early, and we've got a big reset in valuations. So when SPUT first came on the scene, that was very tricky for me, because clearly we got kind of overbought in the short term, but at the same time, I was like, well, yes, we are getting overbought here, but if capital keeps coming into this, they're going to keep buying uranium. And it was pretty much impossible to gauge whether or not capital was going to keep coming into it at that rate. Of course, it slowed down, had another bump in April of last year, but man, it's like the setup is great without the financials. And if they come in, it's going to be a rocket ship.
Good, good. Is there anything that worries you about the uranium sector?
Not about the fundamental setup for the commodity. No, honestly, no. It's like the supply is just, the supply is in a major, there's a major problem with supply here. Actually, I mean, honestly, the catalyst for higher prices for uranium actually could be a big enough problem going out 5 years that we're looking at supply not even being able to get to reactors. That's how bad the supply and demand situation is. I think there's a big problem with trained personnel, which is going to happen. It's going to affect both parts of it, right? So an expansion. Okay, so if we look at the liftoff report for the DOE wanting to triple nuclear capacity, the biggest problem with that is the infrastructure and the trained capacity and labor. That's the biggest problem with expansion. So we've got a major problem there, but that also affects the mining side as well. There's a big, we're going to need basically a mining revolution, not just for uranium, but for all the battery metals and all the, that in order to go where we're being pushed to go, there's going to have to be an absolute revolution in mining. And that's a major problem with skilled labor. So that has me a little bit worried going out 5+ years. But in the near to mid-term, even to kind of like the 2, 3, 4, 5 year long term, it just looks unbelievably good. And all of the momentum, with an exception of Germany, but all of the momentum is on the side of nuclear support. It's really quite fantastic, and something that we never expected. So the only thing that really has me concerned in the short term is just kind of the amount that the S&P could fall if we go risk off in the broad markets again, and how uranium equities could perform in that environment. So we could see some more short-term weakness. That's certainly possible. I'm not ruling that out, but that doesn't really worry me. I would get worried based on some actual elements of the thesis falling apart, and that the opposite has happened. It just continues to grow more positive. And for me, I'm in this for the long haul. So these pullbacks for me are just opportunities. But clearly, a lot of people are in pretty poor sentiment here, getting frustrated with the trade. I get it. It can't be any other way. That's just how markets are. So you're going to see the most amount of public expressed pain and frustration near bottoms, and you're going to see the most amount of public expressed euphoria near the tops. And the most amount of buying happens at the tops. Go and chart ARKK. Look at where all the volume is at. All the volume is at the very bottom and the very top. Like the last 15% run in the bull market for that ETF. It's where everybody bought. It's where everybody bought. And then everybody got their ass handed to them when it came down. So the tops and bottoms are always marked by extremes in sentiment. And so on that note, I think we're closer to a bottom than most people think.
Here's a question too. I guess this is my own question. Is there a possibility that the actual physical uranium price outperforms the equities?
Yeah, it's happening right now.
Well, I mean, not like, I'm saying like, you were talking about labor shortages, potential problems with maybe shortages of supply of certain things. I mean, is there a point where we squeeze and the mines can't actually get that material to it, and the commodity itself rockets, but the actual companies, they're stuck with a bunch of inflation and they're stuck with shortages of supplies? Is that a possibility? I'm just curious your thoughts around that.
That's an interesting question. Well, there's certainly, so the last bull market, that's kind of what happened, although it wasn't expressed in the equities performance. It was expressed in that we saw that the commodity go from a bottom of less than $10 to $134 in about a 5-year period. And only one developing company got into production. One out of 500 companies in the entire space. But that didn't mean that the stocks of all of these companies didn't go up. So the sector kind of tends to operate in sort of a perverse manner in which, for example, if Cameco announces that their production is having problems, the stock goes up, right? Because the equity space believes that's going to affect supply, and lack of supply is going to mean higher prices. So to the extent that developing companies don't get into production, possibly that could affect that particular stock, maybe, but that also generally means the sector responds positively to a lack of supply, and lack of supply because the market believes that means higher prices. So a lack of movement, well, let's say a continuation of a movement in the spot price, if it happens really quickly, that's not great for the companies. Usually it's great for the speculators, and will probably be good for the equities as well. A longer term, steadier rise in the price could also be better for the equities than a really, really fast spike. So to that extent, I'm not necessarily pulling for a huge spike coming from financial speculators. I think it happens, but I don't necessarily want it to happen. It's actually healthier for the overall space if it doesn't.
Yeah, I'm just trying to think, because I think normal herd mentality would favor a spike over a slow grinding rise, I would think. Because yeah. I think when people get afraid, everybody just piles in and says, go buy a bunch of uranium, it's getting short. And then they see that, and then more people pile in, and then the capital guys pile in.
Yeah.
and then
unfortunately, yeah,
you end up with the physical commodity outperforming the actual equities, because it's just one big short squeeze that eventually kind of fails. And I don't know, that's not my opinion on it. I'm just saying, is it a possibility that could happen?
Certainly, it's definitely a possibility. Yeah, it's it'll largely be dictated by the capital markets as well. I would argue now that the mining equities are a much more attractive risk reward bet than the commodity. Yeah. Even though the downside risk for the commodity here, in my opinion, is practically zero. Is there something I'm missing and we could see it come down a couple of dollars here and there? Sure, that's entirely possible. But the fact that there's been zero financial buying for 2 months and the spot price is rising, that's telling us something. So I think their downside risk is very, very small here. And the upside risk is probably a 2x, right? So you get a 2x in spot with the risk reward ratio for that particular is fantastic. The mining equities, because they fall further, absolutely they could. But I think we're going to see some serious, serious catch up when this turns. And the reason I believe that is because a lot of the people that have washed out over the past few months, and no judgment here, it's okay. I'm not like judging the people that sold, by the way. Everybody has to do, like, you do you, right? But most of the people that did wash out during this risk off period for uranium equities, they sort of get the thesis at least a little bit. They're kind of believers in nuclear. They believe that it's going to go. They're just frustrated that the equities are not following the fundamental developments, and a lot of them believe it, and they never will. So when they do, I think there's going to be a massive rush of capital that comes back into the space of people saying, "Oh shit, this is actually going to happen," and I bailed out believing that it would never happen. Now it is. Let me the hell back in. So I think that's highly likely to happen. So in my opinion, the mining equities offer a far greater speculation here than the commodity itself, even though the commodity is probably the safest bet, especially in the short term. I think there's going to be phenomenal torque coming from the mining equities when we finally see this thing turn.
I agree. I completely agree. So that's all I've got, Justin, for today. Obviously, thanks for coming on. Appreciate it. And if someone wants to reach out to you, how do they reach out to you or follow you?
That's my pleasure, Andy. Always good to chat with you, man. uraniuminsider.com. I'm on Twitter. I'm not on there that often right now. It's just, I just can't stand the complaining that's happening there. So I'm not there very much, but I am on there frequently enough that you can get in touch with me there if you'd like. But yeah, uraniuminsider.com. Feel free to reach out.
Okay. Well, that's all we got, guys. Thanks for hitting the end. See ya.